I'm very pleased to welcome back to our podium William A. Strauss, Senior Economist and Economic Advisor at the Federal Reserve Bank of Chicago. Bill joined us 3 years ago at the prior summit to discuss economic trends, and he's here to do so today in a most urgent way. Bill is a Senior Economist and Economic Advisor in the Research Department at the Federal Reserve Bank of Chicago, which he joined in 1982. His chief responsibilities include analyzing the current performance of both the Midwest economy and the manufacturing sector for use in monetary policy. He also produces the monthly Chicago Fed Midwest Manufacturing Index, organizes the bank's Economic Outlook Symposium and Auto Outlook Symposium. He also conducts several economic workshops and industrial roundtables throughout the years. He also teaches at the University of Chicago Graham School of General Studies and at DePaul University. He is a past president of the Chicago Association of Business Economists and currently serves as a board member for the National Association for Business Economics and as a member of the Advisory Council for the University of Illinois at Chicago Center for Economic Education. Please join me in a warm welcome for Bill Strauss.
Okay, thank you, David. So, I'm glad to be back with you. How times have changed from the last time joining you at the second annual automation conference. So, starting up here, I don't need to remind you that we're in a pretty tough economy. As of December 1st of last year, the official arbiters in the United States, the National Bureau of Economic Research, proclaimed that the economy had entered a recession, with economic activity peaking in December of 2007 and entering a recession in January of last year. So, and the depth of that recession is deep, as I'll talk about. But often you hear the D word tossed around, the depression and comparisons, especially when we see events like the financial crisis that we have been in terms of events that we haven't seen and authorities being used that we haven't used in the last 70 years, so going back to the 1930s. And it's very easy when you make references going back that far to slip into that view that things are as bad as they were back in the 1930s. So it's bad, though, and I don't want to sugarcoat that in any manner. However, cycles come to an end, and in fact, I think this cycle is coming closer to the end than the beginning of it, clearly. And in fact, I'll show you some forecasts for where the bottom occurs and what will be the strength of the recovery. This, of course, economic crisis started off with the housing sector, where economic activity peaked for that sector in 2005, following a Ponzi-like scheme of people investing in houses with putting very little down and trying to game that system. In addition to that, we have found that following that, the whole financial side of that industry began to show some struggles, certainly with these collateralized debt obligations and structured investments that began to experience losses that a AAA-rated investment should not experience, and that caused some great concern about what is a AAA-rated firm or a AAA-rated security. And so there began to become an aversion to risk, and I'll show some slides to kind of highlight that and where we are at this point. And then, of course, we see the collapse that occurred in September of last year to the financial system, and I'll talk about that and then the recovery of where we are at this point. But we see improvement happening, and there's a lot of monetary stimulus, we've got fiscal stimulus, and more importantly than even those, we have business stimulus. Does anybody in this room want to have a worse year this year than they had last year? And not a single hand goes up. That's part of why these cycles come to an end. Businesses find ways, individuals find ways to do better each and every year. So these business cycles are not a thing of the past, but definitely we see the fact that they do come to an end. So here we have our best measurement of overall economic activity, the growth rate of real GDP going back to 1990. The gray shaded areas are the previous recession periods for the last roughly 20 years. And as you can see, the declines were more recently occurring in terms of the fourth quarter and first quarter of this year. Prior to that, in fact, for the first couple of quarters of the recession, first and second quarter of last year, GDP actually rose. So for those of you who think that GDP is defined as 2 consecutive negative quarters of GDP growth, that is not the definition of a recession. In fact, 2001, we didn't have 2 consecutive negative quarters. We had 3 negative quarters, none of them were consecutive. But it was really the fourth quarter following the financial crisis where we saw GDP fall off by over 6%. Then in the first quarter, we saw a near equal decline, so very, very hefty drops in economic activity. But there is good news, even in the detail here, because that fourth quarter, almost all sectors of the economy were showing major declines. But if we decompose what was occurring in that first quarter data, with a drop of 5.7%, it was led in large part by business fixed investment. That's not good. But the other major part, nearly half of that drop, was occurring because of an inventory reduction that was underway. And I'll talk more about inventories in just a little while. But nonetheless, that's actually a good thing. I mean, if you're going to have a drop, which is bad, let it come out of inventories. That means that when the recovery begins, businesses do not need to work off the bloated inventories that they might be sitting with. And they can get back to doing production and output in a much quicker, and the recovery has a chance of being stronger because of that. And in fact, the weakness that was occurring to the consumer side in the fourth quarter actually showed an increase in the first quarter of just over 1%. So it's not like the consumer has continued to go away. They're out there. I would say more likely it's been kind of flat for this part of the year, but it's not dropping. So when we look at the forecast for GDP, and this has been consistent since the early part of this year. This is data from the Blue Chip, and in fact, this is the data that just came out this morning. And they do a monthly forecast. These are 50 economists, very well known. You probably see many of them on CNBC and other types of programs. They provide a forecast for a whole bunch of economic variables. And what they are forecasting is that economic activity turns positive in the third quarter. Now, barely positive, just a bit above zero. In fact, I would even say not significantly different from zero. So they basically have the economy bottoming sometime, I would say, mid-year. Third quarter, end of the second quarter, sometime around where we are approaching at this point in time. And then in the fourth quarter, we see growth that is a little bit more substantial, but still below 2%. Below what we think of as trend growth for the U.S. economy, a rate of around 2.5% to 2.75%. So all in all, to use a technical term, this year is going to be lousy. So we're going to have each and every quarter below trend, very weak, and then when you look at it on a year-over-year basis, GDP will be off by 1.3%. Following a negative 0.8% from last year, the 2 worst years for economic performance since the 1930s. So again, we can do a whole bunch of these. 1960, the first footnote lists all of the different recessionary periods. And what we see is that historically, these recessions have lasted about 11 months, so just about a year, with a range of anywhere from 6 months is the shortest lived to 18 months as the longest recession we've experienced prior to the current one. Well, given the fact that this one began in January of last year, and I think we can all agree it probably hasn't come to an end in May, and so let's say it ends in June, this month that we're in, that would make it an 18-month.